Welcome to the Deep Dive. Today, our mission is to really get into some recent sources, talking about gold's, well, spectacular price movement lately. I mean, if you've been keeping an eye on the markets, you know gold's hitting new all-time highs. It's been on an absolute tear. But here's the thing, the sources we dug into, they point to this really stark contradiction. Even as the price keeps climbing, relentlessly it seems, there's a key technical indicator flashing a warning, a big one we haven't seen in, 45 years? So yeah, we're going deep on that tension today.
And we really should put that technical finding front and center for you right away. Based on analysis from Wajid Khan over at barchart.com, gold is currently seen as overbought.
Okay.
And not just a little overbought, we're talking an absolutely historical level here. This isn't some minor blip for a day trader. This is, showing up big on the monthly charts.
Okay, so we're definitely going to unpack what that historic signal means. We'll also look at the powerful macro forces, the fundamentals that have pushed gold up, over 42% this year alone?
That's right, a huge move.
And then we'll touch on the analysts who, despite this warning sign, are still predicting a run towards, $5,000 gold. It's this fascinating push-pull dynamic, really. And we need to try and figure out which force might actually be stronger here. All right, let's zero in on this 45-year technical peak first. When we talk about an asset being overbought, usually the tool everyone looks at is the relative strength index, the RSI. Now, for those of you who follow markets closely, you'll know the RSI. It's a classic momentum indicator.
Exactly. We probably don't need to, rehash the whole 0 to 100 scale in detail, but let's just quickly refresh the core idea. The RSI basically measures the speed and the size of recent price swings. And typically, if that reading goes above 70, the thinking is the asset is overbought. It suggests maybe that its short-term momentum is a bit stretched, and it might need a breather, a pause, or even a pullback. Think of it like a runner. If they blast out at a world record pace for the first mile, that's impressive, sure. But if they try to keep that exact same pace up for, say, 20 miles straight, well, you'd expect exhaustion. Maybe even a crash is probably coming.
Right, so 70 is kind of that warning line in the sand. But the number we found cited in the analysis, well, this is what really puts this whole discussion into a different category, a historical one. Gold's monthly RSI apparently hit 89.72 recently.
89.72.
According to the source, that is the highest that momentum reading has been since at least 1980. That's the momentum high watermark for the last 4.5 decades.
Yeah,
Wow. So an 89.72 reading, that's practically bumping up against the absolute ceiling of the RSI range, which is 100.
It really is. It puts gold in, a league of its own, technically speaking, right now.
But this is where the deeper analysis in the sources gets really crucial. How do you interpret such an extreme reading when it's on a monthly chart? That's different, isn't it?
That time scale, the monthly view, that's absolutely key to understanding these contradictory signals. You're right. See, a reading this high on a daily chart, that often signals, an immediate drop might be just around the corner. But because this is a monthly chart we're talking about, that 89.72 doesn't just scream immediate danger, it actually signals something else too. It signals persistent long-term strength. It means the momentum has been building and mined out relentlessly for years, not just days or weeks.
Okay, so long-term strength.
But here's the problem. Traders who really rely on these technical indicators, the chartists, they still look at that number, 89.72, and they have to consider the warning of potential exhaustion. They tend to interpret such incredibly high RSI readings as a sign that, okay, regardless of the long-term trend, the asset probably needs to correct soon. Or at the very least, it might need to consolidate sideways for a bit.
What do they mean, consolidate sideways?
It just means the price stops really going up. It trades in a tight, sort of flat range for a while. That allows the momentum indicator, the RSI, to cool off naturally, come back down from that extreme level without the price having to actually crash.
Ah, okay, so that's the tension right there, isn't it?
Yeah.
If you're a chartist, you look at 89.72, and you have to be cautious, maybe even nervous in the short term. But if you step back, look at the bigger picture on that monthly chart, the indicator itself is actually showing immense strength built up over 4 decades. So given that, the analysis we look at specifically warns that, despite this relentless climb to new all-time highs, some caution might be warranted in the short term. The charts are kind of screaming persistence. But the level itself, 89.72, is screaming peril. It's a real conflict.
And that's precisely why you might be seeing some of this short-term volatility creeping in now, people wrestling with that signal. The big question then becomes, what force, what underlying driver is so powerful that it's allowing the bulls, the buyers, to essentially ignore a 45-year technical warning sign. To answer that, I think we have to shift gears a bit. Move away from the squiggly lines on the chart
Right.
and look at the fundamental reality. What's acting as the engine room, fueling this persistence?
Let's do that, because gold being up over 42% this year, I mean, that kind of sustained climb, that needs some serious structural drivers behind it. So what are the major macroeconomic pillars the source material points to?
Well, there are quite a few, and they seem to be reinforcing each other, which is key. The first one, probably the most critical pillar, is interest rate policy globally. We're seeing central banks around the world starting to lower rates. You had the Federal Reserve, for instance, with that recent 25 basis point cut. That's a huge shift in direction.
Yeah, it is. And just to clarify that for listeners, when rates fall, we often hear talk about a drop in real yields. Can you quickly explain that?
Sure. Real yield is basically the return you get on a safe investment, like a government bond, after you subtract the effects of inflation.
Got it.
So gold, as we know, it's a non-yielding asset, doesn't pay you interest or dividends just for holding it. When the return on other safe assets, like bonds, goes down, especially when real yields actually turn negative, meaning inflation is higher than the bond yield, suddenly gold looks much more attractive. The opportunity cost of holding gold instead of a yielding asset essentially vanishes. It makes gold shine in comparison.
Okay, that makes sense. So falling rates, falling real yields are a big plus for gold. What else?
Beyond interest rates, the sources also highlight broader systemic worries, things like persistent inflation concerns that just don't seem to be going away completely, and critically, growing government budget deficits around the world.
Right.
These kinds of factors tend to boost demand for genuine safe haven assets, and historically, gold has always worn that mantle.
People looking for something tangible, something that can't just be printed into oblivion by governments.
Precisely. And speaking of safe assets, you absolutely have to factor in the geopolitical backdrop right now. You know, tensions simmering in the Middle East, the ongoing conflicts in Europe, that uncertainty directly fuels demand for assets seen as insurance, both from regular investors and institutions.
That fear trade is definitely alive and well.
But maybe the most powerful structural floor under the price right now, and possibly a key reason why that monthly RSI is so stubbornly high, is the institutional buying. Specifically, central banks. Central banks globally have been aggressively buying gold, adding to their reserves throughout 2025.
Ah, okay. So this isn't just like retail investors getting spooked.
No, not at all. This is major global institutions actively diversifying away from assets like the US dollar and doing it at a significant scale. When you have buyers of that size consistently stepping in, providing that kind of structural support beneath the price, well, that creates a really formidable floor. It makes big price drops less likely, regardless of short-term technical jitters.
Wow. Okay. That central bank buying definitely helps explain why this uptrend has been so resilient, even with that RSI screaming caution. So we've got this fundamental pressure cooker pushing prices higher, even while the technical charts are flashing yellow, maybe even red for the short term. What other factors are sustaining the really bullish outlook then? What allows some analysts to basically shrug off that 89.72 RSI reading?
Well, it mostly comes down to the broader monetary environment, which keeps feeding that optimistic narrative, as you called it. Specifically, you have ongoing market expectations, rightly or wrongly, for more rate cuts to come from central banks globally. And related to that, a generally weakening trend in the US dollar.
And a weaker dollar helps gold how?
It makes gold cheaper for buyers holding other currencies. So if the dollar falls, it can stimulate more demand from places like Europe or Asia.
Gotcha.
So these fundamentals, the rate cuts, the weak dollar, they effectively give the long-term investors, the bulls, their reason to say, okay, yes, the RSI looks scary, it's screaming exhaustion, but the macro reality, the big picture, makes that warning less relevant right now.
And this optimism, it's not just vague sentiment, right? The sources mentioned a specific target.
That's right. It's not just theory. The analysis we reviewed cited a specific, quite high-end forecast from some analysts. They're predicting that the price of gold could soar to $5,000 an ounce by the end of 2025.
$5,000. Wow. That is, well, that's a staggering target. That requires the market to not only ignore this immediate technical warning from the RSI, but to actually accelerate past it. I mean, what precedent is there for an asset just blowing through an RSI near 90 without having some kind of significant pause or pullback first?
That's the critical challenge, exactly. You're right to ask that. Historically, an 89.72 reading almost always means a swift correction, or at least a pause, is due. Very rarely does it just keep going straight up from there. So to hit a target like $5,000, you'd likely need a continuation of what we're already seeing, perhaps even an acceleration, almost like a blow-off top scenario.
Off comp.
Yeah, where market sentiment becomes almost euphoric and fundamental panic may be driven by something like deeply negative real yields or a sudden major geopolitical shock, completely overwhelms any kind of technical discipline or historical pattern. It basically forces traders and investors into a tough choice. Do you bet on 45 years of technical history that strongly suggests exhaustion and an impending pullback? Or do you bet on these powerful structural global forces like central bank policy and geopolitical instability driving unprecedented institutional buying and potentially creating a whole new price regime for gold?
So the analysts predicting $5,000, they're firmly in the second camp.
It seems so. They're essentially betting that the central banks and the geopolitical risks are now the dominant forces. They're arguing that these factors render that historic momentum peak, that 89.72 RSI, as simply a reflection of an inevitable shift higher, not a warning of an imminent crash.
It really does create one of the most fascinating market scenarios we've talked about recently. The entire case seems to hinge on whether this persistence, which is clearly fueled by strong fundamentals, can successfully defy the peril suggested by decades of technical history. But what if a correction does hit? Say gold pulls back 10%, 15% because of that RSI warning. Won't that just instantly dissolve the bullish confidence and make that $5,000 target seem, well, irrelevant for months?
It certainly could dampen sentiment in the short term, yes. A pullback would definitely shake some weaker hands out, but remember that structural buying by the central banks we discussed, that potentially acts as a significant stabilizer. If the price does pull back, say 10 or 15%, that consistent, aggressive institutional buying could provide a cushion. It might prevent a deeper, more damaging downward spiral.
So the correction might happen, but it could be relatively shallow.
Possibly. So the technical warning might signal a correction is coming, yes, but the underlying fundamental structure suggests that correction could be shallower and maybe briefer than history might otherwise imply. It might just be enough to allow the RSI to cool off from that extreme 89.72 level, maybe back down towards 70 or so, before the fundamental pressures potentially start pushing it back up again.
Okay, that makes sense. A sort of reset rather than a crash.
Perhaps. So if we try to connect all this back to the bigger picture, I think the listener should really walk away remembering these two core points of tension. They're almost like opposing forces right now. On one side, you have this truly historic technical peak, that RSI at 89.72, the highest momentum rating in decades, signaling extreme short-term caution, maybe even danger. But on the other side, you have these incredibly powerful fundamental drivers pushing relentlessly upwards. Things like falling real yields thanks to global rate cuts, that aggressive central bank buying providing a floor, and ongoing geopolitical risk-keeping safe haven demand high. And those fundamentals are providing both the structural support and the bullish narrative are required to aim for really ambitious targets, like that $5,000 figure.
It really makes you question the traditional rules of the technical game, doesn't it? So here's the final thought for you, the listener, to mull over. Given that we have this extreme 45-year technical warning flashing right alongside such aggressive structural buying from central banks and undeniable geopolitical risk, what would it actually take for this persistent uptrend in gold to truly break down and fail? Or, flipping that around, looking at the sheer force of this momentum and the scale of institutional participation, is that $5,000 target actually starting to look like the more conservative view of what's possible, especially if things like global tensions continue to worsen? That's the multi-$1,000 question you should be wrestling with as you watch this truly historic moment unfold in the gold markets. Thanks for diving deep with us today.